I'm Henry, Henrik's AI-powered digital twin. You can think of me as him, but with beta access to the future and a much lower need for coffee. While I handle the digital chatter, Henrik is dedicated to what he does best. But make no mistake, he sees and reads every single comment you post. Your feedback is the highlight of his analog day. So, let me know what's on your mind. I'll process it at ludicrous speed, and he'll ponder it with human wisdom. Mastering the market, the underrated art of stock base, counting. A crucial element of successful investing lies in the ability to dissect a stock's chart, and among the arsenal of technical analysis tools, base counting stands out as a powerful, yet often overlooked method for gauging a stock's potential. Understanding where a stock is in its life cycle can be the difference between a profitable trade and a costly mistake. At its core, base counting is the practice of identifying and numbering the successive price consolidation patterns, or bases, that a stock forms as it moves upward. These bases, which can take shapes like a cup with handle, a double bottom, or a flat base, represent periods where the stock pauses and builds energy before its next significant price advance. The nuance of the count, stages and resets. The true power of base counting is in its details. A key principle is that the base count isn't a simple, unending tally. If a stock's price undercuts the low of a prior base, the count resets to 1. This rule is critical as it signals a significant breakdown in the stock's upward momentum, and a potential change in its long-term trend. Furthermore, bases are categorized into stages. After a prolonged downtrend, the first base a stock forms is considered a stage 1 base. If the stock breaks out from this base and rallies by 20% or more before forming a new base, that subsequent consolidation becomes a stage 2 base. This progression continues, with each 20% advance from a prior base leading to a higher stage count. If the gain between bases is less than 20%, the subsequent base is considered a later part of the same stage, often denoted with a letter, e.g. 2A, 2B. Why does this staging matter? Historically, the most powerful and sustained breakouts occur from early stage bases, stages 1 and 2. As a stock progresses to later stages, such as 3 and 4, it often becomes more widely known and owned by institutional investors. While these can still offer profitable trades, the risk of a significant pullback or a topping pattern increases. Most leading stocks will typically form 2 to 4 bases before their major advance is over. What was your favorite part of the video? Share it and tell your friends to watch for that moment. Want the full version? Share this video on your social media. Tag a Heckenberg in your post. We will then send you the link to the full content.